Welcome to Clutch Radio. Welcome, curious minds. Today, we're taking a unique profit and loss plunge. We're diving into the world of investment banking and the wider financial system.
Hmm.
We've pulled together some really interesting insights here, stuff from university lectures, financial outlooks, and, some pretty deep economic papers.
Right.
Our mission, really, it's to give you the key knowledge on how this whole sector works, how it's evolved sometimes in surprising ways, and, well, the complex forces shaping it. Think of this as your essential primer.
Exactly. We'll be looking at how these financial institutions actually function day to day, the really critical role of regulation.
Which is huge.
Absolutely. And the often unexpected ways policies can end up influencing stability and growth, too. It's like a peek behind the curtain,
Yeah.
seeing the mechanics that move money in markets.
Okay, so let's unpack this first bit. What is investment banking, really? It's a term that came into its own in the 1930s, mostly describing firms helping businesses or governments.
Or even individuals sometimes.
Right, helping them create and issue securities, so stocks, bonds, that kind of thing. And it's different from commercial banking, which takes deposits. A pure investment bank doesn't have, savings accounts.
What's fascinating, I think, is that investment banks often do more than just issue shares. They act as strategic consultants. A really core function is underwriting.
Underwriting, managing new issuances.
Exactly.
Yeah.
Like an initial public offering, an IPO, for a company going public.
Mhm.
And this whole business, fundamentally, it's built on trust. They have to do serious due diligence.
Why is that so critical?
Well, partly to prevent moral hazard. That's where a company might try to issue shares even if they know they're, say, about to go bankrupt. But it's deeper than just avoiding fraud.
Okay.
That trust,
Yeah.
it's actually fundamental to the whole market stability. If it breaks down, well, the ripples can be massive, systemic even.
So managing confidence, not just money. You mentioned Goldman Sachs earlier. What was their stated principle?
The line often quoted is, "Our clients' interests always come first." It speaks to that idea of loyalty, listening well, maybe even keeping a low profile. Cornerstones, supposedly.
Okay, and here's where things get, really interesting. The history. It's just tangled up with regulation, isn't it? A real roller coaster.
Absolutely.
You had the Glass-Steagall Act in the 1930s in the U.S. that famously split commercial banking, the deposit-taking side from investment banking.
Right, that's when J.P. Morgan had to split, creating Morgan Stanley as a separate investment bank.
A major structural change.
Definitely. But then, the pendulum swung back. Glass-Steagall got repealed in 1999, the Gramm-Leach-Bliley Act.
Why the change?
A lot of it was about global competition. It pushed the U.S. more towards universal banking, where banks could do both commercial and investment activities, which was common elsewhere.
But then came the 2007-2009 crisis.
Exactly. And that exposed the risks, didn't it? Leading to a new wave of rules. Think the Dodd-Frank Act. That brought in the Volcker Rule.
The Volcker Rule that targeted proprietary trading, right? Banks trading for their own profit?
Precisely. It prohibited that at commercial banks, which really hit firms like Goldman Sachs hard, given how integrated they'd become.
Yeah.
Dodd-Frank also put significant restrictions on banks dealing in complex derivatives, things like swaps, trying to curb systemic risk.
And it wasn't just the regulated banks, was it? There was this whole other system.
The shadow banking system.
Yeah.
Yes. Firms like Lehman Brothers, before they went bankrupt in '08, they operated a lot like commercial banks in some ways.
How so?
They relied heavily on short-term funding, like repurchase agreements, repos. But they didn't have the same kind of regulatory oversight or safety nets. It really showed how financial activity can sort of migrate, move outside the traditional boundaries when rules tighten up.
It's incredibly complex.
It is. And the whole sector just exploded in size from the 1980s onwards. A huge part of that was asset management growth.
Mutual funds, hedge funds, private equity.
All that. Plus, a dramatic increase in household credit, especially mortgages, often packaged up and sold as securities. Securitization.
Right. But here's the debate, isn't it? Does all that growth actually, benefit society overall?
That's the question. I mean, professional asset management definitely increased market participation, diversification, good things. But there are real concerns. High fees, for one. Active managers often underperforming the market indexes anyway. And some argue it pulls top talent away from other important fields, like science or engineering.
That's an interesting point.
And another really crucial point, maybe more down to earth, is financial fragility. It's kind of shocking, But studies show over a third of American households would struggle to find, say, $2,000 for an emergency.
Wow. And not just low-income households.
No, it affects middle-income families too. And what seems to make a huge difference, according to the research, financial literacy. Just understanding basic financial concepts significantly reduces that fragility. It really empowers people.
That makes sense. So looking ahead now, say, towards 2025, what are firms focusing on?
Well, alternative investments remain a big area, but also, crucially, integrating AI, artificial intelligence.
AI in finance. Yeah.
Across the board,
Yeah.
really. Sales, distribution, enhancing data analysis, even supporting critical thinking. But it requires really robust data systems and organizations that can actually adapt. It's not just plug and play.
Needs the right foundations.
Absolutely. And pulling this all together, this profit and loss plunge, it reveals some real paradoxes, doesn't it?
Like what?
Like how even things meant to be helpful, like government-sponsored mortgage securitization. The idea was to create safe assets can actually make crises worse by sort of encouraging banks to originate and then quickly sell off riskier mortgages, shifting the risk elsewhere in the system. Counterintuitive, right?
Definitely. And other policies, too.
Sure. Things like deposit insurance or the idea of banks being too big to fail. They provide stability in the short term, yes, but they can also create moral hazard. Again, encouraging more risk-taking down the line because there's an implicit safety net.
So what's the bottom line here? What should people take away from this, especially maybe if they're thinking about finance, perhaps for an investment class they're taking?
I think it shows the financial world is this incredibly dynamic mix of innovation, regulation, and fundamentally human behavior.
And then understanding it isn't simple.
Not at all. Critical thinking isn't just, a nice-to-have asset here. It's essential. Really essential for grasping the subtle and sometimes not so subtle impacts of policies and market shifts.
It's a field that's constantly changing.
Constantly. Exciting, yes, but one where real foresight and sound judgment are,
Yeah.
well, they're truly priceless.
Thank you for listening to Clutch Radio.